commentary for Monday, the 22nd of September. I'm actually going to mute myself here in a quick second, and I'd like Brian Strain. It's, don't tease him about his last name too much, but Brian Strain is the newest Hurley Investments registered investment advisor. He's going to be working with us, and he's going to get to do a commentary next Monday. So Brian, I'm going to mute myself. Would you take a couple minutes, introduce yourself, where you come from, why you got suckered into working for Hurley Investments?
I'm happy to talk to everybody. So it's been a while. I met Kevin back in 2017. We met through mutual friends, but I've been in the investment world, in the education background is where I come from as well. I used to work with Don Fishback. That might be the most popular name that you've heard of that I worked with. We were working closely together, and Kevin started pitching me because he saw what I did, and he started pitching me on switching over to becoming an advisor. And this last year, I finally took the leap and did it and got my license and decided to go with it. So I'm excited to get to know all of you guys a lot better. I'm an options and probability expert, and that's why Kevin brought me in. And I'm excited to bring what I have. I'm gonna next week when I come to visit and I have a presentation, I'll introduce you guys a little bit more thoroughly on what it is that I bring. But in the meantime, if you want to view my website, it's Brian Strain, and Kevin misspells my first name all the time with a Y. Yep. brianstrain.com. It's built. It's just a resume about what I bring, and it talks about what we do for people. You'll see some examples that I put up there of a small account where I was teaching my son how to trade options, and you'll be able to see that. And I've got statements up there and things that you can look at. But I'm an expert at bringing people with small accounts and helping them grow them into bigger accounts. And the nice thing about that is that options are a fraction of the cost of owning the stock. So it gives us a lot of leverage. But I'll talk more about what I do specifically next week, but I'm really glad to be here. Thank you, Kevin.
Thank you, Brian. Glad he's here as well. He's going to be a wonderful addition to Hurley Investments, and he will be a great investor for those smaller accounts, meaning probably like $100,000 or less, that need more time and want a little more leverage to grow up to that $100,000, where you can maybe take a little better advantage of that caller trade. I'm excited. I'm excited to have Brian. One, because I stole him from someone with a big name in the industry, and two, because if you can do it, you don't teach it. You go do it for other people and you get paid what you're worth. So Brian, glad to have you here. Excited to have him with me next week when I'm going to turn the majority of the time over to him. Now we will keep, for all intents and purposes, we will keep the same template of what we're doing, but we'll definitely introduce you to the probability trading that Brian has done over the last decade. And Brian, just to let you know, it looks like Abraham has said, welcome, Brian. David, and Mary are also welcoming you. So welcome to joining the Hurley Investments family.
Thanks,
it's interesting
everyone.
because I'm going to be a little bit different. Maybe not so much about teaching, but I'm going to show you what I see. I get an investment advisor magazine and an registered investment advisor, what would you call it? Like best practices / hey, here's the new rules and regulations that you're up against. And here's a page that I scanned. A lot of fun here, but we talk about it all the time. The EQL, an equal sector weight ETF. And notice how they have on the left, overweight in the right places. Technology, financials, and consumer discretionary. That's what's made the money. Really, technology, or the Mag 7, has made over 84% of the S&P 500 gains over the last 3.5 to 4 years. Financials has made up a big portion, double digits. Discretionary was the third. Yet what are they pitching? They're pitching, you need to bring your portfolio back into balance. Out of curiosity, just give me a quick yes or no. Who here thinks the Mag 7, the Mag 11, or the AI technology is done growing? Who thinks, hey, you know what? We should no longer be there. Those are not going to give us 80% of the returns in our market in the next year. I love this one. If you want to be nice with everybody, you won't make money. You need to concentrate on the winners. I love that answer. That's a great answer. The Mag 7 hasn't stopped yet. I agree with that one. Anyone else? Anyone else think, hey, technology, artificial intelligence, it's over. The run is over. It's not going to make money in the next year. Is there anyone that thinks that way? Give me a quick yes or a no. Yeah, a bunch of no's are coming in. Of course not. I'm shocked at how things keep going back to what hasn't worked since really the late 90s or 70s, excuse me. The buy and hold, it's shocking. But this is what I'm getting pitched. Hey, as a registered investment advisor, you need to bring balance back to your portfolio. You're overweighted, put it in crap that won't have a good growth moving into the future. Shocking. As your registered investment advisor, I would expect you guys to have me do the work. I would expect you guys to expect me to spend my time finding those opportunities there where things are really taking off. Don't forget, once you balance, you've got to put something into a REIT. I just want you to look at this as I looked at it. Alliance Mortgage Fund, the alternative MREIT investment. Preservation of capital, provide security, stability, and predictability, mitigate risk through diversification, provide monthly growth or income, or growth options. Yields of 7.39, average distributions of 7.12. I'm kind of looking at some of this and going, eh. And then I went to property types, income producing residential. 67.95% is in apartments. 27.24% is in commercial, 4.81% is in land. The loan to value is 51.67. You normally want to see that in that 75 range. If it's a commercial income producing residential property, you want to see it significantly higher. Lien position, 55% is in a first position. 44% is not. If we were to hit a recession, 44% gonna go in the crapper, to put it this way. Location, Orange County, LA County, other areas. That's when I started to laugh. Oh, it's California. And I knew it right away. I knew, you know what? This is a loser. This is ridiculous. Meets IRS protected fund. Tax efficiency. Real estate secured. No, it's not. First year lock period in place. No, it's not. Custodian approved. No, it's not. This is the biggest. I hope you guys read the small print. I'm going to bring up the small print here, and you've got to read some of this because it's amazing. All right. I want my highlighter because you won't believe me if I don't highlight it. Interests are being offered in reliance on an exemption from the registration requirements of the Securities, got to move it out of the way, of the Securities Act and are not required to comply with specific disclosure requirements that apply to registration under the Securities Act. I love it. The Securities and Exchange Commission has not passed upon the merits or given approval to the interests, the terms of the offering, the accuracy or completeness of the offering materials. What they just said is they bypassed what they should have done. Interests are subject to legal restrictions. You should not assume that they're going to be able to resell those interests. Involving risks, investing in interest involves risk, I mean, that's always kind of normal. But what I really enjoy is we are not required by law to follow any standard methodology when calculating and representing performance data. Oh my God. How can they publish such bullshit in an advisor publication to help me know what the new rules are, follow the new rules, have alternative investments? We are not required by law to follow any standard methodology when calculating and representing performance data. Can you now understand why being an independent RIA is so important? I don't know who out in California is pushing this, but it is being pushed, I would assume, to the tune of somewhere between $40 to $50 million on a colorful brochure that does not mean anything, that its bullet points contradict the small print. You have to be reading the small print in everything that you invest in. I have never seen a bigger bunch of garbage in my life. Yet it's your responsibility to not get caught up in the pretty brochure, to not get caught up in the bullet points, to not call Lisa Viejo, California, on their toll-free number to get in as quick as possible because there are only a limited amount of spots. So you got to get your money in quickly. You read the small print and it tells you everything you need to know. Now, very interesting. Again, you've heard me talk about this for a couple weeks. For those who approach me about becoming a registered investment advisor, there was a pretty interesting article that I put in here for you guys. Should I join an RIA or start my own? And it starts off, well, if you start your own, you got to be one of those that wants to build something on your own. Starting your RIA is the closest thing. An RIA is a registered investment agency or advisory firm. Starting your own RIA is the closest thing to true independence you can get in this business. You set the rules, build the systems, create the firm that reflects your vision and values. The benefits, your full ownership. It's 100% on you. It's also neat because in 5 to 10 years, the big push is, you know what? How much can I sell my firm for? And yeah, there years ago, I could have sold it at 4 times earnings. Right now, I can sell it at $120 million of revenue uh, of assets under management with about $2.5 million of revenue. That's the end game. Very few people are in it for the long haul. Freedom of choice. You're no longer stuck with a limited investment menu or venue list. You get to pick the custodians, the tech stack, the legal partners, the marketing team. You get a full say in how it's run. You're not in there getting a brochure where the office gets a bonus if $10 million goes into this crap. Culture and brand control. You control the onboarding process, who you bring in, your mission statement, all the stuff that makes you look pretty. Exit flexibility. You're building a scalable asset that you get to sell. Pass it to a junior partner, right out for 30 years. It's like 98% of all registered investment firms sell within the first 10 years. And then there's personal fulfillment, where you get to grow something as you stress out for all these years. But there are trade-offs on the left-hand side. I love this part. Compliance and legal setup. You need to file your ADV, draft your advisory agreement, and establish a compliance calendar. That might mean that you're acting as your own CCO or hiring a compliance consultant. It's doable, but time consuming and high stakes. Startup costs and time. I want you to pay attention to this corner, this paragraph in the left-hand corner. Launching isn't cheap. Expect to spend on legal fees, insurance, technology, payroll, office space, staff, and more. Most advisors plan for a 3 to 6 month launch window in a 6-figure investment. Setting up your own RIA can really run into that $75,000 to $100,000 minimum investment to get started. Operational burdens, billing systems, cybersecurity, data management, HR protocols. It can be lonely. If you're coming from a team-oriented culture and have a strong CSA, solo journey can feel isolated. So this is not for 20 to 35-year-olds. Pressure, pressure, pressure. For the first 12 to 18 months, I would say for the first 12 to 18 years, you'll be the CEO, the COO, the CEO, and sometimes, guys, it's rewarding, but it's also exhausting, especially if you're the primary only revenue producer. That is what you're up against if you want to do it yourself. It's neat. There is some stuff here on the other side. Hey, if you join someone, thank you, Brian, for joining me. Why does it work? Hey, we've already got a built-in infrastructure. There's a faster revenue ramp up because you have the name and the history behind you. Lower financial risk because you don't have to foot the bill to get started. Support systems are in place. Your peer network's in place. The trade-offs, limited customization. Some RIAs have some rigid investment menus. Yeah, at Hurley Investments, we're not going to put you into funds. No mutual fund, no REITs, no high commissionable products, no bonuses for the business that a little bit gets passed on to the investment advisors. We don't do that here. Reduced payout, kind of neat. I pay my guys better than Goldman Sachs or Merrill Lynch, Morgan Stanley, JP Morgan. I pay my guys better than anywhere else out there. It's simple. I wouldn't have their money if it wasn't through them in some way, shape, or form. I give them the bigger percentage. They make more. They make somewhere between 4 to 6 times more than a Goldman Sachs, all those ones I just named, than one of the big boxes makes. Cultural fit matters. You gotta believe in the methodology. You guys all should be ridiculously happy this year. We could have done it last year if we weren't stuck with Schwab. Cultural fit matters. Schwab did not fit Hurley Investments. Relative independence. It's kind of neat when it's all on you, but when you got some guys covering your back. The bad news is you're building their brand. Hopefully, though, you've seen, especially through Keeve, right? I'm trying to build my guys to be their own people, but I'm giving them a home and a safety net that you never get anywhere else. For those of you that have been asking me, this is the last time this year I'm going to talk about being an RIA. It's up to you to figure out on your own. Simple answer is this. Good luck getting it started. It'll cost you somewhere between $75,000 to $100,000 outlay before you even start. So if you think you got it, you better have the background, the experience, and the track record that you can stand on your own 2 feet as you go wildly in debt to start your opportunity in the market. I'm giving you all I can give you. I like what Trump said the other day at John Kirk's funeral. Charlie loved everyone. Trump, I hate my competition. I hate my opposition. My job here is not to help you set up your own RIA firm. If you want to give it a try, good luck. Earnings this week. It's only Micron. Micron tomorrow after the market closes. That's the one that's important for us. The big picture did not come out with anything new. There's still $7+ trillion sitting on the sideline. Where will our markets end this week? I've said lower for like 3 weeks in a row. I'm wrong, so I'm following the trend. The good news is, other than 3 stocks, we've been letting things run. I hope you've looked at your accounts, especially the last month, and have gone, oh my goodness, what a year we are having. To be honest with you, I can't remember the last time a September in the market where the S&P was actually positive. Now, I know we've had some somewhat recently, but as I'm actually looking at it, the most recent positive S&P 500 was 2017. They were negative 18, 19, 20, 22, 23. Yeah, I mean, it's been what, 8 years since the S&P 500, according to Google AI overview. It's been like 8, 9 years. 1, 2, 3, 4, 5, 6, 7. It's been 7 years before, well, 7 negative years. The 8th year was positive back in 2017. Shocking. The good news is we trade in a way that even if we're wrong, which I had thought, again, I'm not one to hide it, right? Here we go. Here are all of my weeks. Down 2%, down 2%, down 2%. Flat. I'm adjusting. I'm moving. But thank goodness we just had stock positions that ran like no tomorrow. Thank goodness I can be wrong in my methodology where I don't have to guess right. I don't have to be the 1 out of 3 chance of being right where it has to go up to make money. We call our trade, we protect on the downside. Really neat that even when we're wrong, we're right. We adjust those odds into our favor. We can let things run like Micron and Apple and Microsoft and NVIDIA. I'm forgetting some. Boeing ran this month. We're on the downside on Boeing. Disney's on the downside. In fact, let me be honest with you and show you one that's just, it's just iffy. Kevin, why haven't you protected Disney? Well, we took the 120s off Down around here for a little profit. We put 118s on. We took them off on that one up day. It broke our pivot point. And so, yes, from about 117 to 112 and a half, $4.50, we've had nothing on Disney. Can we put something on for another $2.75 to the 200 day? We could. Are we close to being oversold and looking for a bounce? We are. The willingness percent R tells us, hey, it's oversold. Big money's looking to come back in. Last time it did that, it basically ran 10%. Tough. Kevin, couldn't you see a simple head and shoulders? Yeah. So easy to see it after it happened, right? So easy to see the head and shoulders after it's occurred. Yes, Disney's not one of our better runs through September. We did make a little money on the long puts. We will prepare for a pretty good run into the holidays when Disney usually takes off and takes off pretty nicely. Cash Cow will be the other billion-dollar Avatar movie. And don't forget Christmas. People go on vacation to the themes, to the theme parks. They buy tons of Disney toys and so forth. We think we're going to be okay. Do I wish I had run Disney better? Of course. Is it killing us this year? No. Thank goodness we stayed Magnificent Seven. Something to pay attention though. We are approaching overbought on the Dow, which means we will most likely have some type of run like we had in July, where we need to go sideways, get a little cheaper for a run into the end of the year. Of course, that's the Dow Jones Industrial Average. No one really cares about it. It's a TV index. What matters for us, S&P 500. Dang it, we're already overbought. 13.84%, I believe, maybe it's 13.81% year-to-date gain on the S&P 500. The S&P runs a little differently. We might see a September run much like July, another 2% gain. Good earnings through October. We might see us get up to that 20% range. I think I talked about it last week or the week before. Yes, we could have back-to-back 20% gains on the S&P 500 3 years in a row. We are bullish, but we do need to go ahead and put the caveat in here that bullish, but overbought right now. We're seeing it by 74.49 on your RSI. NASDAQ, exactly the same. Exactly the same setup. Bullish, but overbought. It'll be interesting to see where earnings moves certain stocks and pushes them through the end of the year. All right, already showed you guys September. I've come over to the dark side. It's going to be the first positive year in 7. Earnings, not much happening this week. AutoZone and Micron on Wednesday. Fuller Homes, KB Homes on Thursday. JBL, BlackBerry, CarMax, and Costco on Thursday, excuse me. Wednesday, I meant to say Fuller and KB Homes. CarMax, JBL, BlackBerry, and Costco on Thursday. We're paying attention, obviously, to Micron and Costco. Tuesday, current account balances. New home sales on Wednesday. None of this really matters. Our only pre-market futures movement will most likely come on Thursday with a GDP and GDP deflator, durable goods, existing home sales. That will be what runs our pre-market, and our day will be dependent upon those 5 specific economic reports. Friday, PCE prices, core PCE. As long as it's not running hot, we have every reason to expect an October rate cut and a December rate cut. The FOMC has already dot plotted those out into the future. All right, let's see what's next here. Oh, what are we doing? As I said before, we have taken some profits off of Micron. We've got Micron protected right now in the money. I want to say it's at 165. Let me tell you where our Micron protection is. We are not moving it. If anything, we might take a little bit of profits from our puts and roll them to be at the money. But right now, our Micron puts are at they're October 31, $167.50. So we have in the money October 31st, Halloween. In the money October 31st. Puts in place on Micron. We might roll them down and capture that profit. At the money is really about the best place that you want to be. The reason why we're keeping or why we're debating what we're going to do exactly, it's overbought. We're struggling with having an overbought stock not have in the money puts at this time frame. We don't know exactly what we're going to do, but we have to make our decision before the close tomorrow because Micron reports after the market closes tomorrow. All righty. Got to get back to my very interesting article. Fund manager reveals the rule that made him 2,000% return on one stock. It's the so-called Circle 3 rule. Only pick stocks that have an attractive valuation, strong business fundamentals, and a positive business momentum. Here I thought I had just found the Holy Grail. Oh my gosh, guess what? This is what everybody does. Anyone that believes in Buffett in any way, shape, or form, you do your fundamental analysis. Your fundamental analysis should show you that they have an attractive valuation. If they have an attractive valuation, they are in an area or a sector that has positive business momentum. Again, we have known this for 3.5, almost 4 years. 80% plus of the S&P 500 have come from 11 to 13 stocks. 1 year it was only 7. For crying out loud, put your clients in those positions. Another very interesting article that I highlighted some areas that I wanted you guys to know. A complete guide to value investing, how Warren Buffett made his money. Warren Buffett has long been a proponent of value investing, an approach taking the long view, holding your nerve, avoiding risky behavior. Philosophy's budget learned from economist Benjamin Graham's 1949 book, Intelligent Investor. What is value investing? Value investing refers to buying a stock, trading below its intrinsic value. Oh my gosh, we just heard that, right? Something that values your stock being cheap by an objective measure. I love Buffett's idea. If you've done your work, holding stocks for a long, long time. Value investors aim to hold stocks until they reach what they calculate to be the price that reflects their intrinsic value. which means when they're fully valued. Yes, it can take years. Do you want to have your research show you that you can forget about it for a long, long time? Now, there's a reason behind this. Long-term holding strategy means value investors are less concerned about factors that affect the market in the shorter term, as in conflicts or political events. The difference is we're not Buffett, right? None of us in this group have billions of dollars and we can afford to sit and wait for things to come back. We do something different. We add that long put when a stock has an 80% chance plus or more of losing 15 to 25% of its value. That happens 4 times a year during earnings. We protect ourselves when it is most probable that a stock will lose somewhere between 15 to 25% of its value. I love the idea because in general, we are doing what Warren Buffett has done. We just have the fact of the matter that, hey, we can't wait for forever. We have to do something that's actively growing our stock base by protecting with long puts and converting those profits into more shares of stock. I really enjoy this and love this. Value versus growth. Growth stocks are typically those investors think will grow faster than the rest of the market. Apple, Nvidia, Microsoft making up the top 3 can't read it, constitutes of the MSCI World Growth Index. Index annualized returns of 13.56% in the last 10 years means it outperformed the World Value Index by more than 3% or more than 5 percentage points. Over 50 years, however, value stocks have slightly outperformed. Again, a fancy way of saying it. If you're not in these growth stocks, then value stocks over 50 years will outperform them. We don't care. If for 10 years we can beat the market by 5 percentage points, if we can be profitable in 2008, the market will never catch us. If we can have a year like we're having this year because Micron, Google, Apple, Nvidia, Palantir lose 50% of their value and come back, the market will never catch us. We're where we need to be and we're in great shape. All right, a couple more articles for you. I just enjoyed this one. S&C's trade likely with China before November deadline on reciprocal tariffs. That could be a bump in the road for us in November. Market track record is flawless when the Fed cuts its rates with the S&P 500 near record high. Remember we talked about possibly getting up to 7,000 by year's end? I think we're on our way to do that. What does the Fed decision interest rate mean for mortgages? It's interesting because it's not running the way it's supposed to. It's a choppy way down. We thought the quarter point, half point rate cut, the dot plot giving us 75 basis points of rate cut this year, possibly another 50 to 75 next year. Interest rates should have been coming down much faster. They're not. This is a local article from the Desert News out here in Salt Lake. This is what we're dealing with the uncertainty of big banks fighting the Fed. We've been taught don't fight the Fed. Big banks don't know what to do, and it comes back down to they don't want to supply mortgage rates under 4%. It's easier to lend amongst themselves or to lend to the Fed than give the risk to the consumer through residential loans. Here's the proof. Make sure you read the article. One more thing, I guess I'm putting it on today. Out here in Salt Lake City, K&K Strategies, the mom and pops hedge fund is a Ponzi scheme. Here in my own backyard yet again, People are coming up with things that are too good to be true. You guys have your returns in your accounts. Don't get caught up in all the other garbage that's out there. Auto trading, Bitcoin, Dogecoins, cryptocurrency. You have the answer right now. If you want to lose money, please go try some other people that are in Ponzi schemes. And this was funny. One of you sent this to me. I think you got it from, I got mine from Morningstar, but they didn't write it. Forgot who wrote it. Probably Market Watch wrote it. Stocks are at risk of correction if the Fed makes the right call in the economy, says Morgan Stanley. It's a very interesting article. This is the polite way of saying we're overdue for a correction. And you can't fight the Fed, but the market might still go down. It's so funny because we have all these rules set up in the market. This always happens. The probability of this happening is this, blah, 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 blah. Here's Morgan Stanley saying, you don't fight the Fed because the Fed's going to make the right call. We're going to lower interest rates, but we're still going to have a correction. Understand, you never fight the Fed, but there just comes a time when one domino falls where one hedge fund cashes in its chips and the next one gets scared and it does it, and the next one, the next one, the next one, and before you know it, we have our 7 to 20% pullback, and then we usually march higher. Are we at risk if you are scared of the current economy, the current political climate, if you're scared of being a conservative, if you're scared of tariffs? Yes, there is a very mathematical equation that says we are due for a 52% pullback. The probability is like 3.25 standard deviations. And I don't have the exact number, but it's like 17 quadrillions of a chance of it happening. Are we going to have a correction in the future? 100%. Yes, we're going to. Will it be a 3 to 7%, a 3 to 10%? Most likely. But is there a chance for a catastrophic 52% correction? Morgan Stanley, I think, is the one that calculated and justified it. Yes, there is a mathematical chance. We've got the answer for that. We'll double up or triple up on puts. So we make 2 or 3 times the amount that the stock loses on the way down. We've got the solution, but it's not a probability. It's a possibility, but the probability is so far out there, it truly isn't something you have to worry about. Guys, what questions do you have for me tonight? What questions do you have for me that I can possibly answer for you, that you would like me to answer for you? Or should we just call it a night and look on to next Monday when we're going to hear much more of Brian and maybe a lot less of me? Bruce, good to see you here. It's been a while since we've seen Bruce. Bruce Mormon is here with us tonight. Always welcome to have you here. Jonathan Parker, you're a new one. I haven't seen you come by. Let's welcome Jonathan. We hope to have you here every week and any week. And again, if you guys have any questions about anything stock market related, what we're doing, now's your time to ask. Bill, Abraham, always appreciative of your comments. Stuart, good to see you here tonight. Stuart, make sure to look at your accounts. I think you'll be very happily pleased with where you're at. Brian, you got another couple people welcoming you, but they're spelling your name right, which might be a little different. Again, Jonathan, hope to see you here every week. That same link that brought you here will bring us next week. I'm stalling to see if any questions come in, guys. I don't see any questions coming in. Have a wonderful evening. Appreciate you being here tonight. I hope this is helpful. We will get these notes posted as quickly as we can. It'll probably be up tomorrow morning. www.myhurleyinvestment.com. That's our blog site. Hopefully this was good information for you guys. Do make sure you go back and check the notes out. Some of you I know like to print them out. Big things this week. Micron's earnings tomorrow after the market closes. Thursday, GDP, durable goods, existing home sales, PCE prices on Friday. Guys, have a wonderful evening. Appreciate you being here with me. Look forward to seeing you next week. And Brian, I'm anxious to see what you're going to teach us next week for that first 15, 20 minutes. Good night, everyone. See you next week. Bye-bye.